a number of esteemed guests. So on the far end there, we have Ken McCullum. He is the Senior Vice President and Chief Risk Officer of Principal Financial Group. He's responsible for helping the company identify and successfully manage risk across the company to deliver the best value to their customers, employees, shareholders, and communities where they do business. He joined Principal in April of 2015 as the Vice President and Chief Actuary. Prior to that, he was at Delaware Life, Sun Life, the Hartford, so quite a career. He's a fellow of the Society of Actuaries and a member of the American Academy. Next to him, we have Pooja Raman. She is from Protective Life, where she joined in June of 21 as the Senior Vice President and Chief Risk Officer. She's responsible for leading Protective's enterprise risk management function and overseeing the implementation of the company's strategic risk appetite, enabling organic and opportunistic growth. She has over 2 decades of experience in risk finance, legal, and technology. She has her Juris Doctor from Drake, so we're pleased to have you back. And then next to her, we have Lori Graham. Lori is the Senior Vice President and Chief Risk Officer of American Ag. She is responsible for leadership, innovation, governance, and management of the company's ERM program. She also oversees corporate services, which includes corporate risk, research, product development, and marketing. She has over 30 years of experience in underwriting, risk management, and research. She has numerous industry designations, including CPCU, ARE, ARM, and AIAF, and also loss control management, research and planning. She has lots of letters to put after her name. So, so I want to thank you all in advance for participating and look forward to the discussion. So we have a few kind of set questions that we're going to talk through, and then please be thinking of questions that you may have because we're welcome to take that from the audience. So for our first question, as we think about the variety of changes and issues that are facing our world, climate change, tech advances, demographic changes, shifts in our political landscape, which emerging risks do you think need the most attention right now? Lori, can I start with you?
A really exciting time to be in risk management and a really scary time to be in risk management, as risks are more complex and more interrelated than they've ever been in the past. It's a really noisy world right now. We've got a lot going on, and figuring out how to scan the environment and focus on the risks that are most important to your organization can be difficult. For us, risks to strategy are the most important risks. So we have an emerging risk task force in our organization that's a multidisciplinary team that identifies emerging risks and does deep dives on those risks to inform the executive leadership team about which risks they feel that we should be focusing on. The risks that we are looking at right now, obviously, as a global reinsurer, we're aware of the economic changes that are going on and all of the events related to political processes. A lot of these risks are external to us, so we can't really mitigate or manage these risks. What we can do is improve our resiliency and develop risk response plans and determine where the opportunities in those risks are and how we'll respond to them. One of the challenges, I think, in post-pandemic, and I know we're kind of all still focused on that, and are we really post-pandemic? I think we're post-pandemic. But what we're looking at is which risks from pandemic are persistent, that they've changed the way we operate, and are going to be something that's a permanent part of moving forward, and which ones are just kind of getting back to a new state of normal. We've all seen pressures in retaining and attracting talent. That's one of the ones that is top on our list. There's been an unprecedented growth in e-commerce, virtual conferencing, and streaming. And digitalization has also increased our cyber exposures. So while we want to take advantage of things like cryptocurrency and an opportunity to provide insurance for very small and needy sectors of the marketplace through cyber and through parametric insurance, we're keenly aware that there's an increase in cyber exposure for us. And again, as mentioned earlier, ESG is a particular area of concern for most insurers. We have been managing ESG risks since we started. I mean, insurance companies have these risks in their portfolio. We've been managing and tending to these risks But they've been adapting and they've been changing and we've been adapting over time. And now it seems like we're getting all these requirements from regulatory and rating agencies to be transparent and to bucket these risks into certain categories and measure them in a prescribed way. So we've done our first ESG statement, and we felt that that was more of a gap analysis. What are the things we're doing today? And then what do we want our future to look like? And how do we go about doing that?
Great, thank you for that. Pooja, is there anything you'd like to add?
Sure. Thanks, Alyssa, and thanks, Drake, for having me back. It's great to be here back in Des Moines and back at Drake. Yes, it's a scary world. It can be even scarier if you don't know how you're going to go about prioritizing, right? So it's a little bit of a materiality assessment on an ongoing basis. What's relevant today and what is sure to be relevant over the long term. And so Lori mentioned strategy, and I often draw the circle of sorry, I lost my voice. I'm not sick, but every time I come to Des Moines, it's the allergies just hit me, and it's been 10 years, so I'm trying to adjust. Part of risk management, I guess, but so it's a little bit of a circle I draw, and you've probably, if you've been in the field, you've heard of how liquidity is air, capital is water, and strategy is food, but they are connected. And so if you don't have your strategy in place, you will have trouble raising capital over time. And if you have trouble, raising capital over time, you can, in times of stress, have liquidity issues. So when I look at all the things that are coming at us, including demographic changes, including what I call megatrends, a consolidating industry, a new set of consumers that chooses to do business and looks at the world differently, I look at that map and I prioritize from a materiality assessment. What's happening now? What's coming over the long term that we can't lose focus on? And then the two things that I think will be important for me to position myself, my company, my team in the right way, and that's where I focus. One is make sure there is the right risk culture at the company. And as the CRO, it's sort of your job to continue to foster that and build that and make sure it stays there with support from senior executive management. So one is risk culture, to make sure we're there and we're ready to absorb what's coming. And when you see input from strategic leaders in risk, it is heard and put into place. And the second thing that I can't stress enough is talent management. You're only as good as your people. You're only as good as the eyes and hands and the heads working on the things that are out there. I tell my team, almost every month, part of your job is to be aware of and remind me of my own blind spots, because it's not a one-person job. And that's true of the most senior levels in my company, where we know we have to be positioned for agility. We know what got us to this point is not what's going to get us to the next few decades. And to position ourselves for that agility, we need top talent, because risks are changing every single day. But if you've got the right risk culture and if you've got the right talent that you continue to invest in, that's how we navigate the coming decades.
Thank you. Okay, so we have sustained inflation, a looming Fed Reserve interest rate hiking cycle, tightening liquidity conditions, the unwinding of our pandemic era economic distortion, among other things going on. This means there's going to be further price fluctuations. How are you evaluating this financial market volatility? And are the tools that you and your teams have historically used working as you would have expected? Ken?
Well, first, let me echo, I thank you for having me here today. Thank Drake for hosting this. Alessa, great job getting this this awesome panel together. It's a real honor to be a part of it. The first thing I would say is this is the type of thing that a traditional financial services life insurance company like Principal is very well experienced in. With 140 years of experience, we've seen financial markets go in all different directions. And so we feel like we do a nice job of preparing for these kind of stresses. But I would quickly add that every time we go through them, we learn something new. And so my first point to the question about the tools is don't fall in love with your models. All models are useful. All models are wrong, or however the saying goes. But but really understand the limits of the assumptions you've made. We tend to do an awful lot of calibration of our models to historical data. And if you just look at the 10 to 15 years that we've been through, and if you just look at what interest rates have done, all of that historical data would have told you it's really not possible for rates to fall as far and as fast as they did, and now to have risen as sharply and as far as they have from such a low level. So we are seeing, once again, something that the models and the history alone wouldn't tell you about. But if you have good intuition, if you think about what could happen, I think you can be prepared for these things. And then, the value of your risk management really comes to the forefront. What does this mean to our company? What does this mean to our business strategies? What does this mean to our capital position? What does this mean to our liquidity? What does this mean to our earnings power? Are questions that you can answer as it's happening from a foundation of confidence that you prepared for it. If you've done the work in advance to do the stress testing and do the hypothesizing of what could happen. So this is not unusual. It just feels in the moment unusual. And this is what, I think our constituents count on us to be prepared for. But if we're going to make a mistake, it's going to be because we're too confident in what we know based on what's happened in the past, having us believe what we think will happen in the future.
You can. Pooja, you're also at a life company. What's your thoughts?
Sure. So, built for times like these, I would echo that, company's been in effect for more than 110 years. We are also part of a larger company that's been around for 140 years. So built for times like these, I will say every scenario that unfolds, we know this by now, is different. We learn from the past, we move towards the future. Don't fall in love with your models. And one thing that has helped me, and the last decade, I like to joke. So the first 10 years, 2000 through 2010, a lot of stuff happened. We obviously had 9/11, we had the financial crisis. There was a lot of stuff happening in that decade. Then you had 10 years of low for long, for sure, but not really too much of an economic meltdown, right? So you start talking stress testing, and you do hear from time to time, well, the Fed's going to act. You're not going to have a 50% decline in equity markets where the Fed's not doing anything. Well, if it's inflation and they're going after inflation, the equity markets can do what they want. That's not what the central bank's going to be worried about in first order magnitude, right? So my learning and reinforcement has been, you have your stochastic approaches, your 1 in 10, 1 in 100, 1 in 50, however you calibrate those. And the rate at which rates have risen, for example, the rate at which inflation just showed up, could have been outside those stochastic models. Sometimes stochastic models are good at figuring out what you're not thinking about because they are by definition stochastic, casting a web. But you have to pair that with scenario testing, stress testing, historical, with some angles laid on terms of historical. We've seen, I like to say we were not all working in the 1980s, but we've learned from people that were. We've learned of the spike scenario. So when we are in the year that we are in today, I'm like, yeah, okay, an immediate spike can happen. We've run these scenarios over and over as a response to inflation. It's going to happen a little differently this time. For the longest time last decade, life insurers were looking at persistency. Rates were low. It was not beneficial for consumers to move. Now we're back to studying, are our lapse functions right? None of the functions are actually ever totally right, but are lapse functions right? What's happening next? What happens if rates rise next year the way they have this year? Again, there's some level of history to go back to, but the point is, are you pivoting and are you looking at data? There's two data pieces. One is, as I've mentioned before, the mega trends, where the demographics are going, how people react today compared to how they did 30 years back when there was no social media, there was no talking to each other. Oh, rates are rising. Is that still beneficial for you to be in a product type that you're in? But again, the historical information of scenarios that have happened in the past, the pandemic being another example, we did have the Spanish flu scenario, 1918, 1919, played out very differently in this pandemic. We had intervention on the economic side because the Federal Reserve stepped in. And then we had intervention on the public policy side where mortality could have been a lot worse than it was at the beginning of the pandemic because we went into shutdown. But there are some learnings of the past as we pivot and position ourselves for the future for the unknowns.
Thank you. So let's shift a little bit. and talk a little bit about geopolitical instability and war, certainly given what we see in the world today. So, as a CRO of an insurance company, how do you think about managing risks associated with those two things? Lori, can I start with you?
For us, we are a global reinsurer, so we do insure outside of the country. Am I on? Can you guys hear me? I'm really quiet. Sorry, I guess. I'll hold it closer. So one of the things that we have to do is we have to look at what countries we're doing business in, and are there any economic sanctions? What are the things that are happening there that could put what we reinsure at risk? So we do monitor these. We use tools to monitor what the geopolitical climate is like in given countries. We also have coverages that we offer that are impacted by these risks. One of them is a cyber product that we make available to our seating companies. Yes. And what we need to do is look at those products and say, do we need to refine language? Do we need to do something differently than what we were doing today? One of the things that we're working on right now is revising the war exclusion and cyber operations. So we are concerned about state-backed attacks on the U.S. and the potential impact to cyber and impact to our infrastructure and how that could impact what we reinsure. So it's in our products, and it's in the way we manage and conduct business with other businesses in other countries, and even as much as how we let our employees travel to these places, the safety of our employees and how they can conduct business when we are in another country.
And how about you?
We're also a global financial services company with significant operations in Latin America and places like Brazil, Chile, and Mexico, and in Asia, in places like China, Hong Kong, Malaysia, Indonesia. And then we have an asset management business, which has a presence in Tokyo and London and really around the globe. And Singapore is another significant spot for us. And I point all that out because it's very much an interconnected financial market that we work in, a global financial market. But as these events and these geopolitical conflicts arise, one of the first tools that governments use are financial sanctions. And we're subject to those from the US. We're also subject to those from all the other countries that we do business in, and they're not always consistent. And it's not always easy to reconcile how you deal with that. And I think as we think forward and as we look at the headlines, we worry that there will be ever more tensions and more of those to come before we get to a more peaceful time, perhaps, with what the world's posing. So we prepare for that and make sure we have the infrastructure and the systems in place that we can survive disruptions to our business that might occur by being right-sized in markets where we're most concerned about it and not having too much of the enterprise net worth or value at stake or too much capital at stake in places that you can't control the geopolitical outcomes. I also spent a fair amount of time talking to an executive at a company that had a strong presence in Russia and essentially abandoned their business, and realized that we hadn't done enough time preparing for the people side of this and how you might get people out of a place that you've sent them to if things change and change quickly. And so we've done tabletop exercises around exactly that and around the potential to have business partners, business relationships that we've established for the long term that have near-term geopolitical considerations that force us to pivot, and making sure that we've thought through how we would handle that, how we would communicate that, how we would communicate that with all of our constituents in a world where those things can change quickly. They can be dramatic, they can be unsettling. So it's a big topic, and it's not one that we think is going away anytime soon. And it's not one that you can be certain of what the next chapter is going to look like. So you have to prepare for a wide range of scenarios on this one.
Thank you. So we've talked a lot about how do we protect ourselves from the downside in a number of areas, but you're all part of the executive team of a company, and you need to really work with that leadership to make sure that your companies are well positioned to take advantage when there's opportunities for new products, strategic investments, things of that sort. So what opportunities have you seen develop sort of over the past 3 years, and how have you helped to be a voice at that table to guide your companies to take advantage of those opportunities? Lori, should I start with you?
Sure. this is the fun part of our job. This is where we actually get involved in the strategic development of new and exciting things in our organization. We use the actual risk management framework. We flip it and use that for opportunity analysis. When we look at emerging risks, we also look at the upside of those risks. So I'm going to give you an old example, and then I'll give you a new example. In 2011, when agriculture started using drones on the farm, we were concerned about whether we would allow aircraft exposures on the farm liability. And it was ahead of a big adoption of these drones for precision ag, but not quite. I mean, it was starting. We were feeling it, and people were asking about it. So we came together as a team. We determined what our appetite was for this exposure. We defined what we would accept and what was outside the boundaries of our risk appetite. We had tolerances. We developed forms. We educated our clients, and we helped them implement a product for their customers so that they could be early implementers of an innovative product for farm. Now, there were companies that were coming up afterwards. Even ISO hadn't had their forms filed before we had done it. And so we felt really good about being prepared to take on that exposure. So that's, I think, an opportunity where you can see something coming, you can determine how much of it you want, you can implement it into your strategy and execute on it. For today, cyber risks, those risks continue to evolve. We offer a cyber product. There's a lot of concern in the industry right now. I can tell you, I purchased our corporate insurance and our cyber coverage increased over 100%. And the requirements just to get cyber coverage were ridiculous. So what we do as an insurer of cyber coverage is we take what we learn and we continue to develop those insights and model those impacts and come up with scenarios and determine how we can remain feasible for our clients within the cyber realm. Another one that you guys probably don't think about because this isn't a product, but we talked about the ability to attract and retain quality people. And people are expecting different things now. We've got a lot of people that have bought into the gig economy and they work out of their homes. Are there new products for new services that are being offered that way that we should be promoting? Then we also have our employees who have different expectations from us. They don't want to come we remodeled our office in 2019, built all these collaborative spaces. And then we all went home for pandemic and we couldn't get anybody to want to come back. And so how do we encourage those people to be a part of a team, to be a part of the collaboration, and yet we're flexible enough that they get what they want to? And that's what we've been working on. We've got a hybrid work schedule now that people can work from home a certain number of days, but we encourage the participation through opportunities for our employees. The other one was environmental, social, and governance. We're required or will be required at some point to provide some type of reporting for transparency in our industry. And how can we take this work that we're doing for ESG and turn it into a competitive advantage? Our stakeholders expect things from us. And if we can gauge what those expectations are and deliver and delight those stakeholders, we get a competitive advantage for something that we're required to do.
Those are really great examples. Thank you for sharing those in detail. Pooja, what about yourself?
Yes, the rate of change, the pace of change, right? Risk or opportunity depends on how you're positioning yourself. Do no harm comes first, but that's sort of level one, right? And you got to move past level one. Things are evolving, demographics are evolving. How people choose to purchase products, what products they think they need is evolving. Lori mentioned this. I couldn't agree more. It's the fun part of our job, and it's becoming a bigger and bigger part of our job. So you start with competitive advantages, right? Everyone has some competitive advantage. Is it quantitative? Is it operational efficiencies? Is it a distribution competitive advantage that you have? And then as you look at megatrends, as you look at demographic changes, as you look at what's on the horizon near term and in the future, how are you leveraging what you're great at and how are you building towards where you need to build? You can put a number of things on paper. We start with the bottom, we start with the downside, we start with the risk thresholds, the risk appetite. What would we be extremely unhappy with, right? What's an outcome we don't want? But then you turn that around and say, okay, if I have limited risk capacity, what's the most optimized outcome for the company that you can have based on this limited risk capacity? And how do we go about bringing that outcome to fruition? So there's a lot of numbers, there's a lot of words, there's a lot of strategy, But at the end of the day, it becomes, for the risk organizations and our roles as C-suite members, I think Alyssa started with this. What do we need to do to position our organizations for that competitive advantage? And I think it's bringing two pieces together. One's the substance that several of us went through, myself included. What's the most optimized outcome when you pull all of these things together in terms of what people want and what we're good at offering and where we can build? But the second thing is influence. How do we influence key decision makers within our organization, continue to build credibility? Because the thing with credibility is if you continue to build credibility, you can use it. And when you can use it, you can drive positive outcomes within your organization. You can have all the numbers in the world and all the talent in the world and all the frameworks in the world. But at the end of the day, it's that ability to influence decisions is what will ultimately position, a risk team to be or not be a strategic player.
Thank you. Ken, you have something to add?
Well, I think first the comments that have been made are really, really good, and I love this question because I do think that our role is incomplete if we're not thinking about this. Part of to try to add a little bit to what's already been said, what I've tried to do is message appropriately with this balance. And as I've thought about this year, what I've messaged is the greatest risk I think my company faces is that we're not growing fast enough to satisfy our investors, our employees, and ultimately our customers by building scale that enable us to continue to provide the additional benefits and services that they seek and invest in the additional technologies that they demand of us. So that requires us to do that strategic overlay of all those things that we're worried about in terms of threats and the change, and what are the opportunities of the digitization and the changing consumer preferences, and make sure that we have strategic plans that are moving the company fast enough. And then we use risk tools of where do we have risk capacity, where do we have risk budgets that say we have more room, to try to encourage particular emphasis on those things that the organization, because of its breadth and its diversification, can support or dramatic growth in, and where do we have those competencies and those capabilities that give us the right to win in those markets, and make sure that we're feeding that. And the last thing that we need to do is put more metrics around as an enterprise. What are the things that we're de-emphasizing, and what are the things that we're investing in to grow? And if there isn't a good balance on both ends of that spectrum, it's hard to argue that you haven't got stagnant. Any one business will argue that they know their market, and today they want to do what they're doing, and they've got to meet today's pressures. And if we collectively do that across the enterprise, we're treading water until we can't. And so we're trying to put more of that lens on how much innovation do we really have going on, and to afford that innovation realistically, how much are we retiring those things that have run their useful course, and making sure that that balance is being struck as an important risk metric around, are we really positioned to take advantage of these ever-changing trends and grow, while we're also positioning to make sure that they don't destroy us.
Yeah. Do we have any questions from the audience for the panel members? I don't know if we're handing you microphones or you just have to speak loudly.
That's a great question. In the minute I talk about it, I guess it's no longer valid, right? I'm sure we're going to say in hindsight, what did we miss? Yeah, the pandemic's a great example of that. We'd all studied those, we'd all modeled those. There was a lot of science that said almost exactly what occurred is inevitably going to occur. And there were an awful lot of business leaders that acted like this was unimaginable when it did occur. But I think it's, maybe not that there's one thing that we're Nostradamus and we can predict that will happen that we're not thinking about. As are we thinking enough about how they all integrate together and what it all means? Or are we too focused on thinking about this risk, this thing for this product or this P&L? And I think finding a way to integrate that to what does that mean to our industry and our society? Even as we did a lot of modeling of pandemics and we did desktop exercises of pandemics, I will admit immediately, we never really thought through all the implications of the lockdowns that were inevitably going to come. what that would mean to the economy, to people, to mental health, to all to the healthcare systems, we were underprepared in the preparations we did because we thought about what would it mean to our business, what would it mean, how do markets react, how does mortality react, how does morbidity react, and we made sure we could handle all that. But the knock-on effects we underappreciated. So that would probably be the theme I'd leave you with, is if you're thinking about something that could happen, think a lot around the periphery of what else might that mean.
I agree with you. I have a list here of what our industry is facing this year. Significant economic impacts from Ukraine, cyber impacts, inflationary pressure, strain our rate adequacy, decline in surplus and industry caused by a decline in investment values and rising underwriting losses. Severe convective storm in the U.S. consumed 5% of the earned premium in the first half of the year. Hurricane Ian estimated as high as 60 to 70 billion. It's a highly litigious Florida market. Claims are rolling in slowly, and we don't know why. Wildfires through September of 2022, there were 51,606 wildfires in the U.S. that burned 6.8 million acres, which was a 20% increase over 2021. So when you think that you can imagine a scenario and stress test something, this past year has been unprecedented in the number of peripheral factors that have impacted our risks.
So I'll add two things. One, it's not something that qualifies as it's not being talked about or we're missing it. But there's a lot of talk about a recession, and I don't worry about a recession. Yes, rates are going up because inflation is enemy number one. Whatever needs to happen to control inflation is going to happen. As a byproduct of that, you're probably going to see equity markets, volatility. That's fine. I think we like I said, the last decade, nothing really happened. We've got to stop getting used to that. That's not normal, right? So we should be all prepared for a recession. Hopefully, it's not a deep one. I worry about a stagflation. If inflation doesn't go away, and you've heard this, so it's not new. But I do worry about if inflation continues to be rampant. We continue to go down that path, and if there is a perception that we can't get inflation under control for a longer period of time, you could be looking at a stagflation environment. And the rules of business, right? The rules of our businesses that we are in, the rules of the economy are very different in a stagflation environment than they are, in a what I would call more market downturn, recessionary environment. So that's sort of number one. So worry about that, think about that, plan for that. The second thing, and I've touched on this, but I'll leave you with an example. You talk about competitive positioning for the future, you talk about opportunity, and you often hear about market share, right? But do we even have the right number for market share? I'll give you my own example. This is what happens when you spend more than 2 decades in the life insurance space, right? So people talk about rolling CDs. I have rolling life insurance policies, right? I'm like, every 10 years before my next 30-year policy is going to expire, I'll go get another, right? So it's about once every decade and a half endeavor. It's not too long, but even with simplified underwriting, even and my last policy was before I joined my company. It's just wherever you go, right? It's not company specific. But how many of us have sat through a phone call that goes on for like 40 minutes asking me about my history, medical history from like, they have something in my medical records. Oh, you had something, whatever in 2004. By then I'm at 35 minutes. I'm frustrated. I'm tired. I'm like, I wish I could just save this and continue it tomorrow with a cup of coffee or listening to music, right? On online instead of just like going at it and trying to figure out what I did in 2004 or why was I, so it's just if we were to make the process of insuring, and as a life insurance company, I will also tell you that when people say something, we tend to believe them a little more than when it's just coming through online. Just there is some evidence of people tend to be more truthful when speaking. Okay, but they're also very frustrated if they're anything like me, because like 40 minutes in or 25 minutes in, I'm sort of done. I'm like, maybe I'll just buy a life insurance policy in 6 months. I don't need it now. I have enough for now, right? So that view towards market share, and are we even looking at the right market share, and how could you increase the overall pie, not just your share of the pie?
One thing that I would add is we talk about it, but I don't know if we're doing enough about it, is the change in the workplace. And, we talk about, oh, we got to retain and we got to attract talent. People move much more quickly than they did in the past. That's a huge economic burden on companies, right? To train people and then have them leave after a short period of time. And then you're sort of missing that middle level, which you then have to pay up for to attract from somewhere else, et cetera. But even when we're now talking to people that will enter and maybe they're going to come into a fully remote environment or a hybrid environment, are we even asking them the right questions for us to understand? So if you enter in that environment, how do you plan to learn about the company? How do you plan to learn the company's processes? Have we changed the way in which we train people and onboard them in a very different environment? Yeah, we did what we had to do during the pandemic, and you kind of, you know, with some duct tape and whatever, stick something together that will get you over the hump and get people trained up enough to actually do their job. But it doesn't really give them the same sort of launch pad and network of mentors and other things that many of us longer in our career benefited from. It's a very different environment, and it's harder to build those sorts of relationships. It's great that events like this are coming back, that people have an opportunity to interact with one another and build more informal networks, et cetera. But I think there is a lot more thinking that we have to do in order to make sure that we're really going to be able to get everything we need to out of our employees, but also prepare our employees to actually have lengthy and valuable careers in whatever industry they choose. Are there any other questions from the audience? We got plenty. Okay.
I love that comment, and I think you're spot on. And I think it's broader than insurance, frankly. I think all industries to compete for the talent of the future are going to have to be much better at describing their purpose and demonstrating that they live their values. We all have purpose statements. We all have values. That's no longer sufficient. And you have to work hard to bring that to life. The way that we're used to talking about our businesses and our companies does not resonate with people that are trying to figure out, why are you here? What good are you doing for society? Why do I want to be a part of it? We also have to do a better job with diversity and inclusion in every way measurable, with our employee base, with our customer base, with our entire mission. We have tended as an industry to go where the money is, and that's a way to be a profitable and successful business. But we can't leave behind the people that need what we provide, that need financial security. We've done, and we're in the early innings of trying to figure this out, but we've done an immense amount of research to try to understand and benchmark global financial security. Where is it at, and what do we need to do about it? One of the clear things that's been identified from that I'm super excited about is one of the ingredients that matters the most right now is employer support. We're talking about employer models are changing, but the reality is those countries that score the best, employers do an awful lot to help their employees access financial security, retirement savings, protection products, life, disability, all the things that we know so well. So we need to do a better job of promoting that first and foremost, not our selfish interest of what do we want, but our social interest of, in our lane, what do we know, which is financial security, which is a good and noble purpose. what's needed to make it be successful and encourage that. And that comes at a time when companies are talking about the great resignation and how do we attract. And so part of our value proposition is part of theirs too. It's not sufficient, but it's necessary that if an employee signs up with a company, they believe they're going to be getting financial security as part of that employment experience. What does that look like and how do you get there? But if we can't compel people that our purpose is good and noble and that we're accessing and providing capabilities to folks who've been left behind in the past, we will fail to attract the next generation of talent. And that is a major risk if we don't evolve how we go about it.
Yep. The only thing I would add is it starts with a story. You have your storytellers, each of us. It's not the corporate communications department. It's not just the CEO. All of us are ambassadors for the organizations that we work for. And all of us have a duty to say, tell that story again as credibly and as honestly as we can. So I start with like, okay, I'm a work in progress, right? I am and will continue to be a work in progress. I don't have everything right. I'll continue to learn and evolve. And I think companies should also be upfront, right? This is where we're at. We're continuing to evolve. There are things we can do better. It's not that, oh, we have this down, because again, today's generation, people are not going to buy that, right? It's not something that words are good, actions are better, right? Actions that can look at words and that people can see that those actions and words are connected are better. Otherwise, you could leave people in a state of confusion. So one, what's your story? Second, is it continuing to evolve? Is it continuing to be credible? And third, we're all ambassadors. It's our jobs to tell the story, influence the organization to continue to care for these things that are changing in the workplace, expectations that are changing, for the next generation that's going to be replacing us in the near future. What do they want? I like the fact, I love the fact that I'm one of 5 women. When you talk about gender diversity, I'm one of 5 women on the executive leadership team of Protective. That we have 43% of the total workforce is women. That's something that matters to me. But that's also our job to be able to tell that story and to continue to find our way down that path, that being one example.
I think they summed it up amazingly. Transparency, honesty. One of the things that I still find a challenge, though, is as a risk practitioner, the opportunities I've been given were because I was present in the organization, because I was a part of the growth of the organization, getting opportunities because I was noticed or given a chance to try something or do something. And with remote employees, I find that a big challenge. Remote risk management employees, you really need to know the inner workings of an organization to truly understand that. And so that's a challenge I'm facing. If anybody has any help with that, I had recently hired a risk management professional, and I had people from St. John's University, which has an enterprise risk management program, and they wanted to live in New York. They didn't want to come and experience our culture, our organization, and learn about our organization. That's hard for me in risk management.
It's another great question, and it's something that we humbly think we've gotten pretty good at partnering. We think that is a key part of our strategy, that we aren't going to be able to be end to end in all the places we try to serve the market the best at each capability. You have to pick your partners wisely, clearly. So there's a lot about culture, there's a lot about shared vision and purpose, and you have to manage the relationships hard over time. And you have to also ultimately probably accept that some will work out, some won't, and have an exit strategy for those that don't, and an ability to kind of accept that and move on where appropriate. But that's been kind of core to how we do business in an awful lot of markets. Certainly in global markets, we need that local expertise, and when we can partner with a firm that brings that and brings that presence, we can accelerate by decades what we'd be able to do in an organic build. So that's it. And when we look at evolving technologies, as good as our technology department is, There are certain things that happen better in the garage, at least when they're getting started, than happen inside the walls of a 140-year-old, 18,000 employee company. And you have to accept that and figure out how to work with that. And so those are critical parts of it. I won't say that it's easy. If it's not in your DNA, you might be kidding yourself. There are other companies out there, I won't name them, but they're just not good at partnering, and they don't, or if they try to, it doesn't go well. But it's just who we are, and it's how we've grown our company.
Yeah, I would compare and contrast two companies. So I'm at Oscar Health now, which is an insurtech, right? Kind of startup. We just celebrated 10 years yesterday. Before that, I spent 25 years at AIG. And the risk appetite to partner with startups, tech companies is wholly different, right? At AIG, we would decide to partner and then we would strangle them to death, right? And we would make them fill out 100 forms and, they had to, meet every little tiny requirement, et cetera, before we even kind of let them do anything, right? It took a long time. So then by the time, you were kind of ready to partner, I think they were weary to begin with. And then, the opportunity probably moved on, right? And then there were some that went forward and we didn't fail fast either, right? We wouldn't spend a lot of money and we would then think it would get better, or we just didn't have a lot of success. The company I'm at now, like, they're the other end of the pendulum, right? They'll partner with anyone, and I'm always like, well, are we their only client? Like, how else are they going to make money? Are they going to be here next month? Like, and like the old risk manager in me comes out like, are we sure we want to partner with them? Like, aren't there other people who can do this better? But there's also an element, because we were a startup, that we want to give them a chance too. And many of these startups, are founded by people who once worked at Oscar or partnered with someone else at Oscar, et cetera. So I do think it matters company by company, and I attribute it to like the risk appetite of doing something with it and being okay with it not working out. And I think as long as you do it in bite-sized chunks that aren't going to be detrimental to your overall business, then it's kind of interesting and exciting to take those chances and know that 1 out of 8 is going to turn out okay and fail fast. Are there any other questions from the audience?
I can start. I speak about a lot of different things, but the potential attacks on, and I always qualify by saying I wonder what I can do about it personally, right? Whenever you talk about a problem, I'm like, how can I help? But one of the biggest things that I worry about, and we worry about cybersecurity. You talk about cybersecurity attacks on your company, but one of the biggest worries I have is attacks on infrastructure, the power grid, just the public works, things that financial markets depend on, things that consumers depend on just for day-to-day living, the banking system over, right? We do some tabletops where how would we navigate around that? Just what would business mean while all of that is down? But to your broader questions, if I do think political instability adds a layer of volatility to whatever is going on. There's always something going on. We were in this inflationary environment. We knew we were going to get in sort of at year end. So we knew rates were going up, and then you add to that fire by having this, this war came in and everything sort of went into overdrive. And so political instability can add to any economic scenario that is generally playing out and impacting insurers and consumers in a country just generally. There is, I agree with you, a heightened risk of infrastructure attacks, infrastructure that each of our companies uses but does not control, right? So it's a little more of worrying about what are we doing as a country to make sure we're safe, just similar to how we protect our borders. I'll also say one of my worries around increased instability is supply chain issues. We've seen supply chain issues throughout COVID. They get magnified. And then again, when you have political instability that involves regions of the world, for example, Europe, right? For example, Eastern Europe. I like to use we have an APD business, asset protection business, great diversifying business for a life insurer. Service contracts. Well, I need people to be able to buy cars. Cars were not available. I need to be able to service those cars. Parts need to be available. Parts were not available. So any of the things that impact our normal businesses, whether it's the economics going on Wall Street or its supply chain impacting Main Street America, will ultimately impact insurers and impacts, geopolitical issues magnify whatever else is happening in our economy anyway.
So I would like to thank our panelists for all of the insight that you've shared with us today, and for the active participation of our audience. And so if you could help me in thanking our panelists, I'd appreciate it.